Hello, my name is Oscar Castro. I'm a certified financial planner here at Saxon Financial Group. Today, I'm going to talk about why the most common retirement withdrawal strategy can actually backfire and reveal a more tax-conscious approach that can save you significant money throughout your retirement. But before we dive into those strategies, let's establish a foundation. So in retirement, you'll probably have access to three of these buckets: tax-free, tax-deferred, and taxable. So traditional 401ks, traditional IRAs, those are pre-tax contributions whenever you make them. So when you're working, salary deferrals, you contribute into these vehicles, you get a tax deduction on your taxable income. But in the future, when you go and withdraw those assets, you're actually going to get taxed at that point at ordinary income tax rates. A critical point for these accounts is RMDs, required minimum distributions. And these occur at age 73 or 75, depending on when you were born. And these are forced withdrawals from your accounts and could actually pose a tax problem down the road. For tax-free accounts, it's kind of the opposite. These are made with after-tax dollars, which means the growth in earnings grow tax-free, and generally speaking, withdrawals are also tax-free if you're 59 and a half and meet the 5-year funding rule. For taxable accounts, these are your typical brokerage, savings, joint rights to survivorship, individual, they go by many names. These are also after-tax contributions. There's no limits, there's no penalties, just whatever you contribute into these accounts. But it is a leaky bucket because you're taxed annually on any interest, dividends, and capital gains. So you want to make sure what assets you're putting into this vehicle. So each bucket has a different tax implication, and the order you withdraw from them can make or break your tax efficiency. So if you're approaching retirement and already retired, chances are you heard of this advice. First, spend down your taxable account. Then move on to your tax-deferred accounts, and then your Roth IRAs. This strategy has a fatal flaw. It's creating what I call the RMD tax bomb. At 73 or 75, it can push you into tax brackets higher than you could have been paying long before then. It also ignores opportunities for tax optimization, as well as doesn't fall through with changing tax legislation. So the question is, are you inadvertently setting yourself up for this tax trap? Well, let's take a look at the federal tax rates. For the tax brackets in the ordinary income space, we could see that it ranges from 10 to 37%. Capital gains tax rates, which is preferential, is 0 to 20. And then we can see the standard deduction, which you can think of as the 0% tax rate if you pull out tax-deferred accounts and fill it up to that limit, but these are for 2025. And so we'll utilize these different buckets to go through a scenario. And so let's look at an example of a tax-efficient scenario where we don't follow the traditional method, but more tax optimized. And so for Jerry and Michelle, they're both age 60. They need income of $100,000, and they have a portfolio size of 1.5 million. So the makeup of their accounts follows their traditional, taxable, and Roth IRA. And so what we'll be doing is pulling $31,500 from their traditional accounts. Now, why would we do that? Well, we know that the standard deduction for 2025 married filing jointly is $31,500. And so when we put these two together, they actually don't pay any taxes for this withdrawal. But we still need to make up that difference. So we're going to withdraw $68,500 from their taxable accounts. And so here we can see we're pulling that amount, and this is subject to long-term capital gains rates. So 60% is basis, meaning 40% of what we withdraw is going to be long-term capital gains. But as we can see, $27,400 is the capital gains, but when we look onto the left side, we already took the standard deduction, so 0 taxes. So the only taxable income that remains is the $27,400, meaning we pay no taxes on this withdrawal. And so we're able to draw from their portfolio $100,000 tax-free. Now, why does this work? Well, you're utilizing the generous standard deductions. You're also helping reduce future R&D obligations, and you're maintaining flexibility. So you're not drawing down that taxable account that we could utilize in the future for future tax planning. Now, let's be clear. Not one size fits all. And so your withdrawal strategy needs to be unique to your situations. So when it comes to Social Security timing, legacy planning, goals, current tax rates, all these are factors to consider. The key is running the numbers for your specific circumstances and in your specific situation. So tax-efficient withdrawal planning isn't about minimizing this year's taxes. It's about optimizing your lifetime tax situation while maintaining flexibility or life's surprises. At Saxon Financial Group, we specialize in creating personalized retirement income strategies that consider your complete tax picture, not just your investments. If you'd like to see how these strategies might apply to your specific situation, I encourage you to schedule a consultation. Remember, the best withdrawal strategy is the one that's tailored to your unique circumstances and goals. Thank you for watching.